Hello, my name is Magnus Petersen. This talk is about the advantages of monthly investing in the S&P 500. It is based on this book, and you can click on the image or the link below the video. Just to summarize what the S&P 500 is, it contains the stocks of the 500 largest US companies. It allows you to invest with a very broad diversification at a very low cost. In the long term, the S&P 500 has returned 9.7% per year on average. But in the short term, the S&P 500 is very volatile. One year it lost half, and in another year it gained more than 70%. Usually, you cannot predict whether the price is currently high or low. An easy solution is therefore to add to your investment in the S&P 500 on a monthly basis. Then you get a good return on average and over time. Let's look at an example. Each month starting January 1993 and for the next 10 years, you add to your investment in the S&P 500, and after 10 years you start withdrawing the money each month. So in January 2003, you would withdraw the money that you invested in January 1993 plus any returns on the investment. We will assume there is no tax. During these 10 years, the S&P 500 increased from $435 to $909, and with the dividends reinvested, it returned 9.6% per year. So if you invested $100 in the S&P 500 in January 1993 and reinvested the dividends, then in January 2003 it would be worth about $250. The best 10-year period was between December 1994 and December 2004, where the S&P 500 returned 12% per year with dividends reinvested. The worst 10-year period was between March 1999 and 2009, where the S&P 500 lost 3.8% per year for a total loss of almost a third over this 10-year period. On average, over all the 10-year periods between 1993 and 2013, you earned 5.6% per year. The period between 1993 and 2013 was one of the most volatile periods for the S&P 500, with two of its largest historical crashes. If you had been unlucky, you could have invested at a peak and sold at the bottom of a crash. You would have lost a third of your money. But you managed to get 5.6% per year on average simply by investing every month. This is optimal in the sense that it is very close to the average for any 10-year period between 1993 and 2013. Now let's look at recovery times. The longest crash for the S&P 500 started on September 1st, 2000 and first recovered more than 6 years later on October 23, 2006, provided that dividends were reinvested and there were no taxes. If you had started investing shortly before the crash and you continued adding to your investment every month and you increased the amount to match the inflation, then you would have recovered by January 2004. That is, you would have recovered in 3 years and 4 months instead of 6 years. This is because you effectively lowered your average purchasing price. We can show the crash in a plot like this. So the blue dotted line here is the amount that you have invested. Remember, this increases every month because you are adding to the investment every month. The red dashed line is what this investment would have been worth if it had been invested in US government bonds with 1 year maturity. This would have been worth a bit more than the cash that you had invested. If you had instead invested the money in the S&P 500, then the value of that investment is shown as a black line here. For example, at the beginning of year 2003, you would have invested almost $40, maybe something like $38. But because the S&P 500 was in the middle of a crash, the value of the investment would have been less than $30. What we can see is that around year 2004, the blue line crosses the black line. So the value of the investment in the S&P 500 is equal to the amount that we have invested, which means it has recovered. So the conclusion is that adding to your investment in the S&P 500 every month has several advantages. You don't have to predict if the S&P 500 is going to increase or decrease in the future. You get a good return on average and over time. And if the S&P 500 crashes shortly after you begin to invest, then you recover your investment faster. The book gives more details and you can click on the image or the link below the video.